Well, let's not forget that 60 Minutes interview Sunday night with Fed Chair Powell. That really set things off on a very strong note Monday, even before that Moderna news. But look at last week, and I think you have to look back to last week when there was some weakness. And in each day, Thursday morning, Friday morning, opening bell, market went higher. And then you had the momentum that sort of generated from that. And then Fed Chair Powell's comments, do not bet against the U.S. economy. More measures are coming. That Sunday night got the ball rolling. And we really continue to hear the same thing. Powell, although sort of not downbeat on the economy at all, but he's downbeat on the coming out of the virus and how it could take some time and more measures needed. The market's keying off the more measures needed. And the Fed is going to be there to continue to support markets, to support the economy, and that's fueled things higher. So that's what we've seen this week. I expect to see more of the same.
Well, let's talk about how supply in terms of the Treasuries has been a focal point for many this week. I'm sure you've been dialed in on it. It's been abundant, to say the least, as far as U.S. debt issuances last week as well, now that I think of it. Yesterday, we saw the 20-year bond auction go off. Can you talk to us about what you saw in terms of demand? And I guess I'm wondering, was it the newness associated with the duration, or is there really true demand for this? And ultimately, will it bring liquidity? That seems to be the real goal.
I think there's the demand. I mean, you have insurance companies, pension funds, money needs to go somewhere, and they are coming in and stepping in to take that. One of our narratives coming out of last week or through last week was get through these auctions. We expect Treasury prices to go higher, yields to go lower. And that started to play out Friday. And then obviously everything sort of got turned upside down Monday with the Moderna news. Although Moderna's sort of been backed out, the market hasn't changed. And the demand, though, for the 20 years was there as well. So I think as we're seeing that 20-year auction come and go, the same way the 10-year and the 30-year went last week, we've seen Treasury prices actually react higher. And in the hour following that, the 30-year bond surged. The prices surged pretty well. And we've seen the 30-year bond yields lower for the last couple of days now.
Yeah, definitely. I've been watching the bond contract on the move higher, the 10-year as well. The futures have been on the move recently. Let's talk a little bit about rates on the move to the upside. Could be seen as a headwind for stocks, or would you see it more as a sign that the economy is starting to get back on track and we're seeing a sense of normalcy start to return?
I don't think that the normalcy itself is going to pressure Treasury prices and support the yields. I think, if anything, looking back to history, and it's something that I've always spoke about and over the past couple of years, is after QE1, QE2, and QE3, within 30, 60 days, in that time frame, you've seen the bottom in yields. Now, the Fed is still talking about more measures. So we're looking at this rather than dragging out QE1, QE2, and QE3 over a 4-year time frame. We're talking about this whole thing taking place in a matter of a couple of months. So I think coming out of it, the quarter four, when we've seen the Fed really just exhaust all angles and we see the bright spot of this economy into quarter one of next year, that's where the bottom in yields is going to come. So right now, I do think we're going to see one more low in the yields, one more washout in the yields, one more surge in those prices. That's how we're positioned here with at Blue Line Futures.
All right, well, we definitely have a well-defined range to keep an eye on in terms of if we do see some movement. Right now, for the most part, sideways in the middle of the range that we've seen throughout the March, or establishing March highs, March lows. Let's talk, lastly, Bill, about what does this mean ultimately for the U.S. dollar, because it's been coming off a little bit, but similarly to bonds and to rates, I mean, for the most part, we've got a well-defined upper, lower extreme as far as the March high and low, and we've been kind of flatlining it in the middle of that range since.
Very flatlined. The U.S. dollar index itself sideways. The euro more or less sideways too. Can't really break out of those ranges. And this is where the dollar has to react. It has to find support down here. Now you know the dollar index is what, 57 or 53%. The euro. There are other currencies that really have continued to go higher against the dollar, and the Aussie is one of them. It's definitely going above that upper band that I imagined in the Aussie dollar. Still, though, I do think that the U.S. dollar is going to find some support, and as we sort of move through that, what I compared the QE1 through QE3 timeframe and through 2012, 13, at the end of that, I think that we're basically going to see the end of this whole period of time similarly. So when we get into quarter three, we're going to see that dollar really strengthen. And that's my expectations in the back half of this year.